Today's highlights. Regulators deliver good news, but after Bitcoin's monthly surge, it pulled back. With interest rate cuts expected, funds are lying low. So why are institutions withdrawing? When has Standard Chartered postponed its $500,000 Bitcoin prediction to? And why are retail investors hesitant to buy as prices fall? Stablecoin issuance crashed and was shut out by major exchanges. Does this favorite project of Ted's still have a future? Using cryptocurrency to remeasure the world, master the 24-hour wealth code, and let's get rich together, step by step. It's Wednesday, December 10th, and this is the Chinese channel Where's the Face Change? I'm Michael. Let's first look at the most important data headlines from the crypto world in the past 24 hours. Last night, both the US stock market and the crypto market surged. Bitcoin shot up from 90K to 94K, then dropped to 92K, showing volatility. While regulators are cautioning against a straight shot to the moon, they're also delivering good news. The US OCC, via its 1188 document, greenlit banks to facilitate crypto transactions without inventory risk. Paul McIntosh from the US SEC went further, announcing that next year they will speed up token classification. For example, Project Crypto's innovation exemption operations will be much friendlier. Just when everyone thought Bitcoin was about to take off, it turned out to be another case of good news released, only for the price to surge and then settle back down. A familiar story. The FOMC results haven't been released yet, and when it comes to capital and sentiment, it's still the same old story. If you can lie low, you won't rush in. Let's take another look. The December meeting is getting closer and closer, and institutions are all taking a "let's not take any risks for now, brothers" stance. Everyone's lying flat. The on-chain data makes it clear. Bitcoin keeps moving off exchanges, with people withdrawing their coins, but USDT and USDC are piling up more and more. Hedge funds have gone straight to their classic escape move. What does that mean? First, they park their money in stablecoins and wait to see how the market plays out before deciding on their next step. So, funding rates are starting to repeat the old story from August to October 2025. How does this play out? Before the meeting, the bulls go all in with leverage, pushing the funding rate to the ceiling. But after the meeting ends, everyone slams on the brakes and the price takes a nosedive. It's the classic scenario of hype before the meeting and a crash afterwards. Right now, the entire market is almost copying the CME playbook one-to-one. Positions aren't increasing, people aren't buying stablecoins, yet there's a crazy inflow of funds. In other words, what's the public narrative? Bro, I'm not going all in today, I'm just here to avoid the risks. So whether or not there will be a rate cut at this FOMC meeting isn't the main point. The key is that volatility will definitely be high. At times like this, instead of betting on a rebound, it's better to focus on survival first. Remember, if you miss out on a market move, you can always earn it back or try again. But if you're gone, if your principal is gone, then it's truly over. Now let's look at a truth we need to talk about. Bitcoin's 30-day profit and loss ratio looks like a snake lying flat on the ground. It's so low it's practically hugging the floor with no sign of turning upward at all. So what does this really mean? In plain terms, don't expect a reversal yet. The market bottom still requires a mindset of endurance. Some time ago, with every real rebound, the blue profit zone would always show a classic U-shaped upward curve, like a warm-up before takeoff, getting ready to launch. But in this round, as you can see, there wasn't even a single sound from the engine. It was as if it fell asleep ahead of time. However, if you think this means a crash is coming, that's way too dramatic. On-chain, there's nowhere near enough panic for a sell-off. Those who needed to cut their losses have already done so. The current market is more like slowly simmering a soup, using time to reshape its structure. And what's most frustrating? The duration of this bottom consolidation is likely to last even longer than most people expect. Even after your patience has worn thin, the market still might not make a real move. The key thing to watch is just one indicator. When the 30-day moving average starts to turn upward, that upward turn is the early signal of a recovery. Before it curves up, everything is still considered the bottoming phase. It doesn't count as a reversal yet. So what is the traditional craft of the crypto world? The more boring and quiet it gets, the easier it is for long-term capital to quietly position itself. Everyone understands this. That's why this current period of low-altitude cruising is likely the dullest bottom, but also the most valuable phase of bottom building. Alright, please like and turn on the notification bell. I'll help you sort through the Web3 world's news that's closest to making money in the past 24 hours. We also welcome you to join our membership. Tomorrow is Thursday, which is our members-only live stream session. We'll address many questions you care about and talk about the secrets to wealth. Alright, let's take a look at today's top news. Standard Chartered Bank previously predicted that the year-end target price for Bitcoin would be $200,000. Now that this round of the market is starting to pull back, Standard Chartered didn't hold back. They directly slashed the target price from $200,000 to $100,000. So this move is pretty much like a clearance sale. as for the $250,000 or $500,000 targets that everyone has been hoping for. When will it reach 500,000? Standard Chartered simply pushed the date back to 2028 and 2030. Some people think this is just postponing the bull market dream, but in my view, this is a classic slow bull style prediction. So the message from the experts is very clear. This round of the market is straightforward and completely different from before. Standard Chartered says that if you're still clinging to the old superstition that Bitcoin will take off as soon as the halving happens, you're just digging a hole for yourself.
Standard Chartered points out that the core reason for the weakening momentum in Bitcoin's rise lies in three structural changes. DAT-type corporate treasuries are no longer making large-scale value increases, causing Bitcoin to lose an important source of demand. ETF inflows have dropped to 50,000 coins in Q4, a cliff-like decline compared to last year's single-quarter peak of 450,000 coins. At the same time, the Federal Reserve's policy path keeps fluctuating, making it impossible for institutions to establish directional positions. The overall market has entered a sluggish phase due to a lack of new capital inflows.
The financial guardrails are shifting. We're getting news after news every single day about it. The financial guardrails are becoming more about the digital economy, things that are necessary for network effects to take hold. All of that has happened. We still see inflows from retail investors.
Bitcoin expectations have been revised downward, but the core message isn't pessimistic. There's short-term pressure, but the long-term target remains $500,000, with the timeline extended from 2028 to 2030. Meanwhile, data from Zhishang exchange tools show the probability of a rate cut has risen to 87%. This is significantly higher than the 67% from a month ago. The macro environment still has potential driving forces.
So right now, the entire market is watching the Federal Reserve to see whether they'll loosen their grip. Last night, Bitcoin surged all the way to 90,400, and Ethereum also soared to 3,300. In just 24 hours, short sellers were wiped out to the tune of $300 million. So one thing to remind everyone is that the Federal Reserve Chairman is set to be replaced next April. So at most, we can hold out until April, and in May, we'll see if the new Fed chair will be influenced by Trump. If they start cutting interest rates and the floodgates really open, then after next April, it's not just the start of a slow bull market, but a major bull run could charge in. I don't know if you're this optimistic, but let's take a look at Teddy's own project, Stable, which has finally launched. So what was the result? The market's reaction was like meeting a teacher on the first day of school, expressionless, silent, not chasing the price, and still suspicious of whether there's insider trading going on. It doesn't feel at all like a layer 1 project born with a silver spoon in its mouth. Everyone originally thought that with his team backing him, he would come out of the gate with a champion's aura. Unexpectedly, he ran into a liquidity crunch, and right from the start, it was a case of stumbling as soon as the doors opened.
The token's performance on TGE Day was clearly lackluster. The opening price was around 3.6 cents, briefly spiking to 4.6 cents before quickly turning downward, with a cumulative drop of over 60% hitting a low of 1.5 cents. The FTV also shrank to just $1.7 billion. Due to the current extremely thin liquidity, the market lacks support from buyers, and major CEXs like Binance, Coinbase, and Bit have yet to list it. Stablecoins have further compressed its initial price support. Compared to market expectations,
Stable's public roadmap from Q4 2025 to Q2 2026 shows plans for enterprise integration, developers, and building the entire ecosystem. They only have a 6-month buffer period. In my opinion, this really isn't the best time to launch. Why? Liquidity is tightening, and crypto prices are pulling back, right? Looking at the market, Polygon Tom is aggressively acquiring retail payment users in emerging markets, while Solana, with its high throughput, keeps dominating the payments sector. So, facing such market competition, if any partner or any link in the chain fails, it could instantly turn this promising layer 1 into a big question mark. Can it make a comeback? It seems that in the next 6 months, there really isn't an answer. Here, there are legends of overnight riches, as well as carefully orchestrated scams. This is a chaotic, lawless dark forest, but it also nurtures a lake of hope leading to the light. The ultimate destination of faith is freedom. The end point of consensus is equality. BitcoinTV takes you through the fog to see the future, so we can all slowly become wealthier together. Will the Malaysian Crown Prince Changxing's issuance of the digital stablecoin RMGDP, pegged to the ringgit and copying Sailor's playbook, succeed? Can stablecoins fill the gaps left by traditional banks? Could tokenized deposits and stablecoins become the perfect combination? Alright, let's take a look at Malaysia. In terms of crypto innovation or the overall crypto atmosphere in Asia, Malaysia isn't really a frontrunner. The country as a whole is still relatively conservative. They need to set the rules and draw clear boundaries before they start moving forward. But now Malaysia's Central Bank and Securities Commission have started issuing licenses to major exchanges. This seems like a signal that the atmosphere in Malaysia is about to change. So what happened next? Just as things were getting started, the Crown Prince of Johor, Ismail Ibrahim, immediately stepped up and took the lead in proposing the issuance of a Malaysian stablecoin.
Recently, Bullish AIM, a telecommunications company under the Crown Prince of Johor, Ismail Ibrahim, launched a stablecoin called RMGDT, which is pegged one-to-one with the Malaysian ringgit and fully backed by ringgit cash and short-term government bonds. It will be issued on the government-backed Zitrix blockchain, aiming to become the benchmark for crypto payments in Malaysia. The product has already passed the regulatory sandbox testing launched in June by the Malaysian Securities Commission and the National Bank. At the same time, there are plans to invest 500 million ringgit, about $121 million to build a digital asset vault. A portion of these funds will be used to purchase HKEX tokens. It's clear that this approach is heavily inspired by the coin hoarding strategy of MicroStrategy founder Michael Saylor.
My company's strategy is the world's first digital treasury company, and because it's digital capital, we've capitalized on it, and we have now accumulated 660,624 Bitcoin.
It's obvious at a glance that RMJDT is trying to copy this digital vault success story. Michael Saylor started accumulating Bitcoin in 2020 and managed to build his company's treasury up to 660,000 Bitcoin. This massive Bitcoin position made all of Wall Street start copying his strategy. But the problem is, the treasury companies that are copying this playbook aren't as glamorous as before. After the big surge starting in 2025, the treasury sector basically cooled off, and only those with real strength could hold on and keep standing. But clearly, Emails is not among those afraid of losing money. He just spent $2.7 billion in August to snatch up land in Singapore. Now he's seriously venturing into the digital treasury business, and everything about him just screams, "I'm rich, I'm not worried." But here's the problem. Whether RMGDT can ultimately succeed isn't something that can be decided just by having money and bravado. Regulation needs to be strict, the business model must be stable, and the positioning of digital assets has to be clear. None of these can be missing. After all, trying to emulate Saylor with a treasury is easy, but actually mastering it is much harder. Is China currently banning stablecoins or banning assets like RW? In fact, there's no need to worry too much about stablecoins completely replacing banks, because the expertise banks have built up over so many years is not something that can be easily replaced. What stablecoins can replace in the next year or two is only the model where banks use reserve requirements to turn a portion of deposits into loans, a model that has been the engine of the economy for hundreds of years. It's just like the Fortune 500 companies. When they deposit hundreds of millions of dollars into JP Morgan Chase, they can immediately get loans at lower interest rates and higher credit limits than what's available on the market. And tokenized deposits, to put it simply, are just bringing this mature model onto the blockchain. Enterprises retain all the compliance and convenience, but now gain the added flexibility of on-chain features. Overall, this is actually beneficial for financial liquidity as a whole.
As we are seeing here, we believe that digital cash is a spectrum of instruments that will coexist in the future, each with different use cases, varying levels of adoption, and different users and investors.
B is currently meeting the real-time settlement needs that traditional finance cannot cover, and together with Tessa, manages over $200 billion in reserves, making stablecoins function as on-chain cash. That's why the 4% to 5% reserve yield is not shared with users. Yet, it provides global, permissionless, 24/7 settlement capabilities. By 2025, the scale of cross-border stablecoin transfers is expected to reach $9 trillion, significantly faster than SWIFT's 3 to 5 day cycle. Enterprises can leverage JP Morgan's GPMD to gain credit advantages and instantly convert to USDC to pay overseas suppliers. This enables seamless switching between on-chain and traditional finance, representing the prototype of the future financial landscape.
Traditional bank APIs can only send messages point-to-point, whereas smart contracts in the crypto world can directly set up a multi-party table. For example, as soon as a supplier receives payment, the bank immediately knows how much financing to provide, and the remittance can proceed in advance. So, the entire process, from deposit to token conversion to payment to financing, flows smoothly, almost like having a cheat code. What do large enterprises need? They need loans and fast settlements, while emerging markets require local credit, and also want to connect to dollar channels and DeFi. They seek flexible, strategic combinations and real assets as backing. Relying on just one tool, just dollars or just banks, simply won't cut it. That's why tokenized deposits serve as a solid, trustworthy foundation. In the future, if we can bridge the two, only by combining the stability of traditional finance with the speed of on-chain technology can we achieve the ultimate integration of future finance. And this very feature could very well ignite the global economy. What do you all think? All right, let's take a look at today's news update.
CZ posted directly, jokingly saying, "Please let the next person to get hacked not be associated with me." He also specifically clarified that he hasn't used WeChat in years, so there's no way he'd send you any Great Wall contract or address, CA, or anything like that. In short, don't trust someone just because they look like CZ. Safety first. Ripple CEO Brad Garlinghouse excitedly posted that the XRP spot ADF just launched, and in less than 4 weeks, its scale has already surpassed the $1 billion mark. The growth is so fast that even Ethereum has to step aside. Institutions are buying in aggressively. XRP is basically flooring the gas pedal and soaring upward. According to Cryptopolitan, the Moscow exchange's crypto futures in November hit 48.7 billion rubles, about $636 million, setting a new all-time record for the platform. Russian investors are really going all in this time. The futures market is even hotter than the winter heating. Polymarket's chart looks pretty interesting. There's a 40% chance that Bitcoin will surge back to 100,000. But the odds of it reaching 110,000 are only a meager 12%, while the chance of it dropping below 80,000 is 24%. It's a real mix of emotions. On one hand, people are nostalgic for the bull market, but on the other, they're afraid of getting burned at the top. Coinbase CEO Brian Armstrong said that originally 10 states were participating in Coinbase's staking service, but now only 5 remain. It's not over yet. But the worst hit was Maryland. After the ban, users there missed out on $8 million in earnings. They're still losing money, which basically means they've been hit hard by the regulators.
All right, so what's the mindset that makes it easiest to lose money in crypto, according to Li Tang? I think everyone needs to understand that the market won't change just because of anyone's personal judgment. Why do we analyze things week by week? Because price action is made up of one candlestick after another. The market only moves at its own pace. If you think it's going to rebound, it might keep dropping. If you expect a crash, it could suddenly bounce back and leave you bleeding. That's why real veterans never try to predict what will happen in the future. Instead, they focus on understanding what's happening right now and how the market is moving. If the trend is up, don't go against it. If the trend is down, no matter how much you like a project, you have to grit your teeth and cut your losses. The people who survive aren't the smartest. They're the least stubborn. In fact, the trend is like a knife. If you hold it the right way, it's a weapon. If you grab it the wrong way, it'll just cut you. If you understood what I just said, please give us a like. If you find our program valuable, feel free to like or subscribe to our channel. All the membership benefits are available here, and we hope you'll consider joining as a member to support us in making the channel even more professional. We also hope to lead our members to thrive together in this bull market. Let's all get richer, step by step. See you tomorrow.